everybody. Welcome to TraderMerlin Show. It is your Wednesday, your final show of the week. As you guys know, I'll be out of town Thursday, Friday, and Monday. I'll be in Las Vegas. I hope I make it back at some point. The perils of going out to Las Vegas. So no shows Thursday, Friday, or Monday, but I am going to do a fun show today. We've got a lot to talk about, and of course, I'm looking for some interactivity here from everybody, so feel free to join in the chat as we progress. My guest today, no stranger to the program. We had the pleasure of working together for several years. He is now the head of trading education at Barchart. He's a CMT, former floor trader on the New York Mercantile Exchange. We've got Mr. John Rowland joining us today, and my graphic looks fantastic. I got him analyzing all of this data, and our topic today is going to be adjusting to the market rollover. John, how you doing, my friend?
Hello, Merlin.
Hello. Good to see you. How you been?
Yeah, I'm doing well, friend. Thank you very much.
Yeah, we're doing this kind of reciprocal co-host host thing. I was on your show a couple weeks ago. Really enjoyed that one. That was a lot of fun. And well, I'm bringing you back on this one. So why not? Let's have some more fun.
Yeah, let's have some fun. I mean, I want to give you credit where credit's due. You came on my show and we talked about the halving and everybody's like all bullish about Bitcoin, and you said, well, I think the market's actually going to come down off of the halving, and so I got to give you kudos on that prediction. So
well, we'll see how we go from here, because 60,000 was kind of that level, and a lot of it has to do with you have all these people using derivative markets, and if you go on to DeFi exchanges, you can use all these DeFi platforms and use heavy leverage, like 50, 100, 500 to 1 leverage on perpetual futures contracts. And apparently, there were so many bullish positions that would have been liquidated at 60,000. And all of a sudden, we fell to 60,000, liquidated all of these bullish long positions, and now everyone's eyeing these short positions that are way above. So it's just the market's playing games. We'll see what happens after this halving here in a few days. Let's talk about something that's more relevant to everybody. And that is the broader markets, right? I think you and I are in that same camp of, well, this may not be the end, but it could be the beginning of something more significant to the downside. So talk to me about, assessing this current market rollover and what things you see out there.
Yeah, so anytime we talk about trying to pick a top, that can be very difficult. But one of the things that I like to do, can you mind if I share for a second?
You share anytime you like, sir.
Thanks, my friend.
All right, everybody, get your screen grabs ready. Get your
yeah. So anytime, can you see me?
Yep, we got you.
Okay. So anytime, we want to talk about trying to pick tops. I love to find tops. You get those parabolic runs and back down. I mean, those ones are okay, but I like to find ones where you find this distribution, as you can see here in this red box. And this is really, to me, a distribution is where we just see shares are just changing hands from those who know to those who don't know, or, from the institutional to the retailer. But
right.
Basically, it's just profit taking. So I love these kind of distribution areas. And then when the market falls out of it, then that gives you a much better indication that this is a topping action. Now, what can you do from this? Well, I think from a risk management standpoint, let me just go down to a little bit lower time frame. If I was going to take a short, right now, I know I have this roof over me. I mean, this is kind of gives me protection. And, for our folks who love supply and demand, a nice little drop-based drop here. So now, any short maybe in this area was probably going to be a good short. If you use this roof, you're going to probably have a limited amount of risk. And then where could the market fall to? Well, I think you can look at, recent levels of demand or some moving averages. Now, we just broke through the 50-day moving average. So maybe you look at the 100, or maybe you look at the 200. And those would be a lot lower. I do notice that today that we did fill this gap here. So that's kind of interesting. Let's see what happens over the next couple of days if we don't find a little short-term support here. But certainly if we take that out as well. Now, if I'm a buyer, right, I'm not thinking about buying this market until my buy entry risk is at least 1/3 of the potential profit I could get on price returning. Now, I'm not talking about returning to making a new high, but I'm talking about returning to this area of distribution. Yeah, retested it, and that might be a lot lower, right? That might be, maybe down around 400 or maybe 390. I don't know that yet, but that would be what I would be start looking for. Now, the other thing that I was talking to you before we came into the show is, um, in terms of, a lot of times folks like to use technical analysis like stochastics and RSI. And, I like RSI and I like stochastics, but I kind of like them as a complementary or enhancing um, technical analysis. And so one of the things that you kind of like to look for is what we call divergence. In case of an uptrending market, we want to see negative divergence. So one of the things you learn as a CMT is that usually the first divergence in a strong trending market, which you can admit that we had a nice strong trending market, the first divergence usually signals a minor correction, and that's exactly what we see here. It's the second divergence is usually the one that is the reversal of trend, a signal. So you can see that that was it took a long time. That's the other thing about divergence. They don't happen in a couple of days. They take a while for the market to roll over. And here's NVIDIA. I mean, NVIDIA. I want to show you again. Look, there's that first negative divergence, and there was that sideways correction action, and then boy, that parabolic move, and now we're really getting that negative price momentum.
Before you go further, which I love this stuff, I keep it there. For some who may not know what he means by a negative divergence. So at the bottom, he's got RSI, which is relative strength. You can see the little blue shaded areas, and he's got those lines drawing down. That shows you that the relative strength index is making a lower high, and that's kind of showing a little bit of weakness with regards to relative strength. Yet the price of the security that's directly above that is continuing to make higher highs. And the belief is in a negative divergence like that, that the RSI is just giving a warning sign that weakness is coming. And you can see the first one he has there on NVIDIA. It did sell off a little bit. It wasn't dramatic. But then we said the second one, according to CMTs, is really where we get that bigger move. And now we're seeing that RSI sloping down and markets are making new highs. So this could be potentially a bigger pullback moment based off of RSI. There you go.
Exactly. And something else that you learn about RSI is that in an uptrending market, the RSI actually shifts. So overbought and oversold gets a little bit out of whack. And one of the things that you can look for is if this is still a strong uptrending market, when we look at RSI here, we'd like to see it hold the 40 level, as you can see, as it did here, and here. Now it is below 50. That is a bad sign. But if it holds above 40 as we price travels over the next week or so, that would actually be a good sign that we might see a recovery or this might be a correction. But if the RSI fell below 40 and then fell back into more what we would call traditionally oversold conditions, which would be, let's say, below 30 or in the 20s, then that would even be a greater confirmation that we're going to see lower price action.
On your chart there, I'm glad you scrolled down because you got the MACD on there, and that's just one other tool, one other resource for people to look at with regards to the way prices are moving. What catches my eye instantly there is on the bottom on MACD, you've got it going back into December of 2022, and it seems like the peak was, maybe got to 35, and that was an extreme back in June of 2023, and then all of a sudden we're up over 60. As someone who's a student of the game and has the credentials of CMT, which I don't have the brain power to do, is that one of those moments where if you have warning signs, all the alarm bells are going off like, oh, hey, man, we are way overextended on, in this case, NVIDIA chart that you have here. Would MACD be used as a further confirmation because it's so overextended, or does a really high MACD valuation mean anything?
Well, MACDs are unbounded, unlike RSIs, which are bounded in that 100% to zero. So you never know how far. But in terms of a relativity of all markets and what MACD usually is, when you get into even the 35 was a large number. When you get into something like 60, that is in terms of standard deviations, we're talking about a super outlier. So yes.
And hence that's why I brought it up, because I don't think I've seen in recent time a MACD over 60. Now, granted, I don't have them on my charts all the time, but I'm looking at that like, whoa, and of course, it's all hindsight right now. We can look at this and say, oh, well, it's selling off now, and I hate being that shoulda, coulda, woulda thing, but I know myself, if I see something that's that overbought or has that big of a trajectory, I'm just waiting for the signal to be going short on something like that.
Right, and that's one of the problems with like a MACD is the market can stay overbought or that momentum can continue for a long period of time. So what we kind of want to wait for is, not only the crossover, but then if, for instance, something what we call a failure swing. Now, this is really more for RSI, but if we get a crossover and then price falls, right, or this MACD falls, and then you get a little bit of reversal here, and then it makes a new swing low, and you can kind of see that. Same, just like a regular chart, that is a really good confirmation. Here, you can really see it well. So we fell out of the overbought conditions in the RSI, and we made this swing low. We failed to get back in. Now, we kind of get a little bit back in, but we didn't get back in. And then we broke down. So when you broke this swing low here, this is called a failure swing. That is a confirmation of the price action that you're seeing. And from that point on, so again, I'll go to a little bit lower time frame. And there's your failure swing right there. And notice that really coincide with the beginning of this kind of sideways to down trending action. Even though we were within percentage points or of all-time highs, right?
Yep. Yeah, it's interesting. I was just if you look at something like NVIDIA, you saw that spike on MACD over 60. I believe that the Nasdaq, the triple Qs, haven't even made it over 10 in the last decade. So that's just
yeah. There you go. Right.
Yeah. Wow.
And then again, right? What's the highest? 10.
Yeah. And you're at 60. So let me ask you this. Being someone who's, again, a student of price charts, and I think that's why you and I get along so well, is for us, it's really about what the price charts are telling us. And of course, when you're trading commodities, it's about knowing the mechanics behind those vehicles. What sort of things would you kind of as a checklist say, okay, now we're officially in a downtrend? Because for the longest time, at least since we'll call it 2009, barring that blip in 2020, we've been on one of the best bull market trends you've ever seen. And it's higher highs, it's higher lows nonstop. And I ran through my audience kind of my thoughts on it, but what would it take for you to finally wave the flag and say, we are officially in a bear market, we've rolled over, and we're trending down? What are the key factors that looking at something like the S&P or NASDAQ would trigger that for you?
Well, I would have to see a couple things. First of all, I would like, some of my more traditional moving averages, say the 20, the 50, and 100. I would like to see them all down sloping, or what I wanted to see an erosion of moving averages, like the 20 crossing the 50, which I think we have, and then the 50 crossing, let's say the 100, and then the old dreaded death cross with the 50 crosses the 200. So those scenarios would tell me that, my moving averages are down sloping. That would give me more onus to say that this is more of a bear market. The problem with trying to pick a bear market in the stock market is that the stock market is designed to go up. So you might have a short-term bear market, which could be a correction, right? And so then again, you have to think about in terms of your own personal trading, what would you deem as a correction in a percentage point from, let's say, a most recent high? So, an 8 to 10% correction to me would be just a kind of a normal market cycle.
Yeah, pullback.
So I think it would be a combination of those two things. Something greater than 10% in terms of a market correction, and like you said, a series of lower highs and lower lows. But really starting to see, some of those more traditional moving averages starting to turn sideways and turn down sloping, and then that kind of that domino effect where you get one crosses the other, and then the next one, and they keep crossing. That just gives more momentum to the market.
All right, cool. For me, it was I'm looking for price to start making new lows, right? It's a simple thing, right? That's not that we're officially trending down, but it's like, okay, you've finally shown some weakness and you're making new lows, and then I expect a retest to kind of rally back up and test maybe some prior lower highs and then make new lows. And from my perspective, that's where we are on these equity markets. We have officially broken down below some area of, I would not want to call it demand, but kind of a pivot point out there for prices. And I can bring up my chart here real quick for everybody so you can see it. Let's see. Here's the triple Qs. I could bring up many more, but we've made a new low. We retested on, this is the retest back here on the, my chart is cutting me off at the bottom, but on the 15th of April, so just Monday, retested, and now all of a sudden we're seeing new lows put in. Now you're coming down into that area that John pointed out at the beginning of the show, which is this gap origin from February 21st. I'm with you. I think if you're going to see a bounce, it better happen here. If not, I think you start to see more gaps close, like this one that goes all the way back into January 17th. But it does smell of a reversal of this giant upturn we've had forever, particularly because you have Jerome Powell kind of stiffening up his comments about rate cuts this year and saying, well, we could keep rates here as long as needed. The talk has shifted a little bit there, which I think puts extra pressure on these markets to the downside. Do you think so?
I agree. I agree with you. I mean, well, first of all, the Fed really has only one tool, and that's short-term rates. And, he might want to lower interest rates, because that's his mandate, or maybe that's what he's being told he's got to do. But the fact of the matter is that he could jawbone it as much as he wants. Janet Yellen can jawbone it as much as they want. But the fact of the matter is the Treasury issuances, the refinancing the debt and the servicing of the debt that we have, they're just bringing so much to the market. And I was telling you that some crazy stats that I looked up before we came.
Share these. There's some of this stuff is going to be kind of embarrassing to us as Americans, but bring them on.
Yeah, in the next bill auction, they're going to bring $380 billion to issuance. And in the first 3 months of 24, they sold $7.2 trillion of debt. And last year they brought $27 trillion to debt. And in 2024, they have to refinance or debt that's going to come to maturity of 8.9 trillion. So, I mean, we throw around numbers like trillion, billion, trillion, blah, 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 blah. But I saw it interesting. Somebody did this kind of mathematical stat, which said that if every American taxpayer from this moment on paid a debt reduction tax of $10 a day, now that doesn't seem like a lot, but let's say $3,650 a year, right? That would be a tax, right?
Yep.
And at the same time, interest rates remain exactly where they are, and the federal government stopped deficit spending. It would take 100 years to reduce the debt.
Where do I sign up? Cut my check. Pretty crazy. It's amazing that, we were talking about this the other day, and someone had said, Tomasino, one of my viewers, sent in a thing, and I don't know if it's real or not, where former President Trump was saying that he would back the U.S. dollar by Bitcoin. And I said, not a chance. There's no way that would happen. It wouldn't work with gold, because then you can't keep printing money.
Right.
And at least with gold, if you print all this money, you could argue, oh, we have the gold, because you don't have to prove it to anybody. You can say, yeah, we have it, right? But with Bitcoin, they could never do it, because you would actually be able to see exactly what they hold. So if they're started printing a bunch more money, where's the Bitcoin that backs that? So you couldn't do that with Bitcoin. But talk to me a little bit more about this issuance. What do you see as the impact of it? They keep issuing more and more treasuries, more and more bonds. How do you see that playing out in the equity markets?
Well, I mean, anytime you talk about interest rates and you talk about equity market, obviously that is a headwind, especially for growth stocks. And I think this is really kind of what we're seeing, is that the growth stocks that kind of drove this market up, over the last, 18 months, a lot of that narrative was on the basis of that the Fed would stop raising rates and that they were going to cut rates. And all of a sudden, the reality now is that, the Fed might say they're going to cut rates, but certainly on the long end of the board, we're not seeing rates fall. If anything, we're starting to see them rise and accelerate again. So I think that is going to be a huge headwind for not only growth stocks, but for all equities even for like something that safe stocks like dividend stocks, because that makes that dividend less,
Hmm.
worth less. Um, I know that J.P. Morgan or Jamie Dimon was talking about he was saying that he wouldn't be surprised if long term rate went to like 8%. I don't think
Whew.
that the Fed or the Treasury will allow that happening. I think there's mechanics that they will intervene if it gets out of hand. And also, I think if that happens, we're talking about some kind of catastrophic global event that could happen. No, I'm saying that might not happen, but um, I certainly think that by the end of the year, at least my target is somewhere in, let's say, the 5.5 to 6%. Again, if you're looking at like a yield curve, that's supply and demand is difficult to tell. But if you look at, for instance, like the TLT, we beta low. What was that, back in November of last year? I guess I don't have a chart right now in front of me, but we made a low last year and we rallied off of that low. But if you look back in the past and you go past the great financial crisis, that below whatever that level was, I think it was around 85, the TLT, which was around 5%. So that would mean that breaking that would probably set us on that path to getting closer to 6%.
Right.
Now, again, long-term bonds at 6% is not the end of the world, right? I mean, I can remember, back in the 90s, and this is how old I am, is, my first house that I bought, my original mortgage was 15%. And when it fell to 9%, I thought I was a hero when I refinanced. So, on a historical basis, 6% is actually a healthy for the overall market, especially certainly for um, you know, the whole investment
Right.
credit bank, especially banks could borrow at a much cheaper rate. And that would get our yield curve back to normal, not inverted like it is now. That's kind of what we need to get to. So maybe that's what we need. Maybe we need to see the long bond get to 5.5, 6%, and see the short end stay here around 3, 4%. That I think would be very healthy for the market, but that pain to get there might not be.
Yeah, I was just gonna say, you say it's healthy for the market, but if we keep that short end where it's at, let's say, let's keep it at 5.5%, and that long end catches up and goes back to a normal yield curve, then what if we do get that 10-year up at, let's just say, I'll say 7%. If you go 7% on the 10-year, that means your 30-year fixed rate mortgages are kicking to 9, maybe 10%.
Yeah,
You say it's good for the markets, but I look at it as that would be very detrimental because now your housing markets are going to start to slow down.
right.
I think that you would start to see the cost of business cost of capital to raise money. If I want to build a new factory, hell, I could have done it in 2020 and got myself some 10 years for 1%. Now I'm forced to go maybe at 7%. I don't know if I can expand my factory. So I think at a certain point, it does become very constrictive.
It does. It's certainly credit crunching,
Yeah.
and maybe that's what we need to stifle inflation, right? Really, I mean, the essence of inflation is, first of all, is $2 million chasing two for goods, but there's also a psychological aspect to it, right? People hoard or they buy intense because they know the prices are going to go higher. So maybe in order to cut that demand, right, you need to force a recession,
Mm-hmm.
and that might not happen until we get, let's say, the long rate, like you said, up until 6, 7%,
Yeah.
right?
Yeah, I think one thing is going to have to give. We can't keep remaining inverted this long. It's just that's unhealthy for the market. So we need to get back to a normal curve. But one of two ways that's going to be accomplished, right? The long end is going to pop up and go above the short end, or that short end is going to get slashed and brought all the way back down. And I don't see that happening. What's your take at this from my perspective is this. I'm curious what you think. If the Fed has a dual mandate number one is full employment, mandate number two is stable pricing. Full employment is a non-factor at this point. If you go back to when we had unemployment around 10% back in 2007, 8, and 9, Ben Bernanke and Janet Yellen were both saying full employment is right around 5.5%. Right? They said that over and over and over again. And here we are at 3.9. So I'm not worried about unemployment numbers until we get to 4.5% maybe. So that's off the table. So now all they have to do is focus on inflation. And if the CPI numbers have been coming out hotter than expected, the core PCE price index numbers have been coming in hotter than expected, and commodities like crude oil and several others, well, cocoa, which probably isn't factored into it, are soaring. That to me shows that what the Fed has done didn't really fix inflation, that it might not be transient, as I said, in 2022. And if that does stick around or continue to trickle up, then we may see no rate cuts this year. So if you have to choose rate cuts this year, are we getting 3, 2, 1, 0, or are we getting a raise? What do you think?
I've said from day one of this year that there will be no rate cuts this year, but it is an election year and the Fed usually does cut. So I think you'll get that ceremonial one cut and then they'll take it right back maybe after the election. But you make a good point here. So what's the scenarios that we say that long run continues to go up and then it gets ahead of the short end, right? But the short end still remains at 5%. And you said that the mandate was full employment. Now, if that creates a potential recession, right, or it slows down demand growth, then what do corporations have to do? They have to cut their costs. Now, if they're spending more on, financing or they're spending more on raw goods, what's the first thing that they're going to do to cut some of their marginal operation, right? Mm-hmm. Is employment, right? I mean, what was the big news story out of Tesla this week?
100%.
Right? So I think you're already starting to see whiffs of that unemployment is going to start peaking up. So then that might give the Fed permission to cut rates, but now they're cutting rates for the wrong reasons, aren't they, Merlin, right? They're cutting rates because of unemployment is rising because we're into a recession, right? This is where they made the mistake. They should have been raising rates long, not talking about this transient, and we should have been at 5% 2 or 3 years ago, and now, and really stifled the inflation. Right now they're kind of chasing inflation. So that, to me, I think is the worst case scenario, is because now you have stagflation, right? And then there is no assets in the world that do well in a stagflation environment.
Yeah, and it's an incredibly difficult situation to get out of. I've done a couple shows on, what the stagflation factors are, and right now we're not in those. We don't meet those 3 criteria. For those who might be wondering, stagflation is a trifecta, perfect storm of you have high unemployment or rising or high unemployment, you have GDP declining or 2 consecutive quarters of negative GDP, and then you also have high inflation. Well, we seem to have danced around some of those factors, but it's maybe changing a little bit here. Inflation's starting to tick back up. I agree with John. I think you're going to start to see more layoffs. And I think this begs a difficult discussion, which we'll get to in a minute, about AI and how it's starting to replace jobs. But I think unemployment's going to rise. I think you're going to see GDP start to slow down here again as this economic crunch starts to hit. So stagflation's not off the table yet. It's still potentially there.
I agree with you. Yeah, for sure.
One other thing, I was on a show with a friend of mine the other day, and he is all AI. I mean, he says all his money is going to every AI stock that he can get his hands on. And I'm like, okay. And he said, I believe that in a year, 50% of the U.S. workforce will be replaced by robots, to which I just kind of said, okay, well, you're a little bit too crazy conspiracy theory. However, at some point in our, down the road, that may happen. What do you think the immediate impact, let's say the next year or two, of AI will do to our current workplace? Will you be replaced by a robot? Will there be a digital Merlin, doing live shows on the market?
Why not?
For free?
Remember that show, Max Headroom?
Max, yep.
Yeah, exactly. Why not? Certainly, the benefit of AI is increased productivity, right? Yep. Well, what is the increased productivity? Well, the increased productivity is the replacement of, let's say the base worker, right? The ant worker, so to speak, right? Yep. So, I mean, I see, even like in like warehouses, like Walmart or Amazon, right? That they're all run by these little robots that run around against shelving. Now, which is really even more fascinating is that some of these warehouses are actually in the dark because they don't need lights on because there's no actually human beings in there. All the robots know where
I didn't
everybody
even
is.
think about that. That is pretty, yeah, you save yourself a lot of cost.
Right. There's your increased productivity. Um, I would say that in terms of employment, AI is a destructive force. Now, there's going to be people that have to create AI, but I don't think that many jobs is going to replace, let's say, a factory worker or a warehouse worker.
At least not in the next year.
Yeah, but the swiftness of AI, right? I mean, the changes that have just changed in, let's say, the last year or the last 3 months or whatever. I mean, to me, I think this is definitely one of those technologies that is a huge disruptor, and I think it's disrupting at a much greater pace than let's say the internet was, or that the telephone was, or that the train was, or
Right.
whatever. Um, and so, yeah, what, 3 years, 5 years, who knows? I mean, we're all just be all sitting around in our couches, and we're all, the whole world will be run on AI. I think they made a movie. I think it was called
They
Terminator
made
or
a few of
something.
those. Yeah, that was one of them. Yeah, it's interesting because I agree. And odd blocker, thank you. He says I don't think so. He says we're here for the real personalities, not artificial personalities. I appreciate that. You're here just to watch me make mistakes, which I do regularly. Yeah, there will certainly be some things that don't get replaced by AI, but I think right now it's just this conversation we can have. I believe if we were to go back and revisit this show 10 years down the road, it'd be like, wow, that was, looking into the future, because I think it will be a real problem down the road, especially as quickly as this automation, these robotic systems are getting better and faster and faster. I watched one of the Tesla robot folding laundry, and I was just drooling. I'm like, please fold my laundry, please. Like, I want a home bot right away. I'm in it. Oh.
No, I'm sure it's not folding your laundry. It's getting the dirty clothes out of your bedroom into the washing machine is the problem,
I don't
right?
mind that. It's like I'm like Kobe Bryant. I'm just shooting it all into a big hamper in the corner. It'll be a robotic hamper. It just folds up and cleans itself. We'll be getting there eventually. But have you played with Sora at all?
No, I haven't.
Oh man, I'm gonna completely destroy your weekend. So Sora is made by OpenAI, and OpenAI does ChatGPT, which is pretty phenomenal. You can do all kinds of great things with it. I think its implications for our markets going forward will be very interesting as well. But they came up with one that's visual, so I could type in, have Merlin Rothfeld walking down the Wall Street and having people on the balcony shooting bows and arrows at him as he's chasing a dinosaur, and it will make the movie. And it looks like a highly produced Hollywood movie. And you heard the Hollywood strike. If you go look at Sora, I'll send you a link later on. You're gonna be like, wow, this is unbelievable. But I look at what that's going to replace, what things are going to disappear because of it. We are on the precipice of great change because of AI, and I'm scared but excited at the same point.
Well, I mean, if AI gets that good, then what is real and what is
That's the question. Yeah.
right?
Um,
So,
this question was asked to me the other day, and I'll get your perspective on it. And that was, do you think that once AI gets so sophisticated and it becomes so ingrained and entrenched and knows all, will there be trading? Will trading exist as a business for you and I to go and try to carve out a little niche market for ourselves and earn a living? Think it's going to go away?
I mean, I think there'll always be some form of trading, right? But look at like advances like gambling, right? Um, you know, like DraftKings or whatever,
Mm-hmm.
these algorithms that can predict, like baseball, right? It can predict what could be the outcome of a game, or how many strikes a pitcher is going to throw, and all this kind of stuff. So my concern would be is that the market becomes so automated. The algorithms are now in charge of everything. And I would argue that they're about 90% of what all the price action. So then, what creates price movement? Right? It's really kind of emotion, right? And this creation of risk, right? And if AI gets so good at predicting where prices are going to be or what prices should be based on some analytics, then my idea is that maybe the markets don't move, right? They just find an equilibrium, right? Now maybe
Hmm.
that equilibrium changes over time. It finds an equilibrium in the markets, right? No, there's no volatility, there's no price movement, right? What gives us the opportunity to find trading opportunities is this kind of what prices this kind of this balance between fundamentals and technicals,
Hmm.
and part of that is what will the market bear, what will the the buyer will pay, right? Sometimes it's referred to as the greater fool theory,
Right.
right? So that would be my concern in terms of if we had an all AI automated equities market, that you know there would be no growth, there would be no appreciation in prices, there'd be no volatility.
Well, it reminds me of there's that one sequence. It's a science experiment where they take like a bowling ball and they tie it to a string and hold it to a beam above it, and they line up like 15 of the bowling balls, and they release them, and they all start to form their own pendulum, and they sync up and they kind of create patterns. And I think that AI in the future will be something like that, because obviously the AI will be looking at how the markets are performing. And of course, if all AI is looking at how the market's performing to base their opinions, they'll develop their patterns. And I don't think it'll be stagnant. I don't think it'll be just this flat line because AI is so intelligent. I think you will still get these big swings in the market up and down. And the little guys, people like myself who are out there trading 1,000, 2,000, maybe 5,000 shares of something, AI is not going to worry about me, right? It's looking for institutional movement and who's really going to move those markets. I think we'll always have a place. It's kind of like saying, does the mosquito serve a purpose in society? Well, I would agree it doesn't serve a purpose in society. But, as a trader, I can feed off all of those other big animals which are moving the market and far more dominant. But I just got to get a little bit out of each one of them, and I'll do fine. The mosquito trader strikes again.
Well, I think contra trend trading would definitely go away, but I think if you wanted to be the tick on the hound dog, right? Just kind of follow what they're doing, that would probably be. But I still think that if, like you said, all these patterns are different, and then all of a sudden they come all into sync. Yeah, you might be right. Maybe there'll still be some price
Mm-hmm.
movement, but will that give you an opportunity to make money? I don't know.
As long as it
I
moves,
mean,
but
that's the question. I mean, I think we could debate this for hours.
we certainly can. It's funny because one of my guys is an engineer here. Tom's already getting all heated up on this one. He says, programs, algos, machine language, AI, whatever, will notice what the other programs do, and they will begin to cooperate in running markets up and down with minimal notice, which is exactly what you and I want, right? Let's be honest. I don't particularly care if Apple does well. I don't care if Apple goes up. I don't care if it goes down. I need it to
Right.
move so I can profit on. So, hey, AI, go ahead and move those markets. It will never be 100% AI, and I don't think that the AI will be looking at my little, my tiny little trades. And so I'll embrace it. I'll be trading until I die.
Well, I will be too. I mean, now that you say that, and I think about algorithms, one of the things they say algorithms do is they create liquidity. Well, they create liquidity until there's undue volatility, and then they pull their liquidity, and that creates more volatility. So maybe what AI does is it makes the markets more efficient, and this kind of that volatility thing that I'm saying is that maybe AI will allow the algorithms to stay in the market in greater volatility moments, or maybe like what you said is it just like you'll get even crazier swings because liquidity will come and go, right?
Yep. Yep. I'm excited. I'll bring it on. I think one thing that I've learned in all of this is markets will never disappear. They'll just modify and adapt to whatever technology, new systems come in place. There will always be a market. So don't worry about it, guys. AI is not going to destroy the equity markets. It may ruin some jobs for people, but as far as us being traders and capitalizing on our own trading, I think we'll all be fine. Let's talk about one other thing. A bar chart, I think, listens to their customers. They do. And a lot of people have been complaining about Nancy Pelosi. Like, God, this woman, just the insider trading machine. She's killing the markets. Well, that's not necessarily true, but all these politicians are out doing their own thing, trying to make themselves rich. Very few politicians get out of office broke. They're usually multimillionaires when they leave. So you guys started up something here new that tracks politicians buying and selling. Am I right?
Yes, that's great. It's under our investing page on our website. And we have two pages. We have insider trading and we have politician insider trading. So you can go there and you can see what our politicians are doing, what are the stocks they're buying, what are the stocks they're selling, the size of the stocks and shares. Now, there's a lot of little crazy little rules, like they can buy, and then they have a certain amount of time. They don't need to declare, like insider trading, they have to declare, I think, within 72 hours. But I think Congress gets like a month or so.
Wow. At least they have
Uh,
to declare now. It used to be there's
yeah.
no declaration needed.
Um, listen, I've used it. I've watched, go in there and I'll look at, and again, some of these guys are, they might just be managing a large amount of money and they're just rebalancing their portfolio. But
Mm-hmm.
a lot of times when I see like an unusual trade in a stock that I'm not familiar with, I'll go and see what that stock does. And, is it a pharmaceutical company or is it a research company or whatever? And then I'll go and look and see what committees that congressman sits on. And when one of those committees is directly related to, the business that stock is going to be in it, then boy, I usually will do some kind of options trade. Now, usually it's going to be a little bit longer time frame because I don't think they're that stupid to do something like, oh, they buy today and an announcement is going to come out tomorrow. But maybe 3 months or 6 months down the line.
Yeah.
So yeah, so I've definitely used it, and I think it's a great tool. Um, but even like when I look at, let's say, some of the stocks that they're dumping, like for instance, I don't remember the exact combination of stocks or what was the scenario that happened, but Pelosi definitely sold a stock that was about to get hit by some kind of government regulation, and I don't remember
Nice.
exactly what it was. Um, and that stock fell like 15%.
Yeah. They
So,
know. Well, I'll
um,
share one little golden little piece here, guys. I everything everybody here knows I'm starting to become much more bearish on the markets, particularly with what's happened over the past couple of weeks with the rollover and making some new lows. But if we go out here and we go to that page that John is talking about here at barchart.com, and I'll copy this over and I will paste that in the chat so you guys can play around with it. It's kind of a cool one. There's it in chat. I'm going to click on the insider trading activity. Just if you want to get an idea of what's going to happen with the markets, this is always a good thing. Notice there's only two companies here, three out of these two lists here that have purchases. There's a Keurig Dr. Pepper had one buy, and then TPL and FCNCP, First Citizens, they had some pretty significant buys, but everybody's unloading. If you look at all the sells here, there's 7 sells on Amazon, 1 on the NASDAQ, 12 on Walmart, 3 on Cinex. I mean, a lot of selling going on here on our politician side of things. And let's be honest, if you were a politician and you thought that we were going to prosper, that the economic policies were going to be very positive and bullish, and we are going to get all these rate cuts, would you be unloading your positions right now? Probably not. I think I'd see a lot
no.
more buys out there. So, this might be one of those things that you can utilize as a confirmation indicator or a supporting tool for your decision, whether to go bullish or bearish, like John was talking about with stochastics and RSI and MACDs. These are pieces that we can use to help, strengthen our decisions. They shouldn't be the piece that makes it, but I think it's very interesting when we look at this chart to see all the selling that's going on in the last 60 days, conveniently right as these equity markets start to roll over. So,
Yeah, I agree with you 100% there. But, I would take it with a grain of salt. And so, selling is legal, selling is okay, and selling is part of the market. So, yes, um, there's a dynamic about bubbles, and there's certain characteristics, and one of the characteristics is insider selling. So, of tops. So, we're definitely seeing that. The other two, one would be a change in credit, and the other one would be corporate fraud. Again, something that is coming to fruition. But I would rely more on it in terms of looking for those who actually are buying, especially from the C-suite. Yeah, if I see a lot of C-suite selling, that could be a good indication. But I think it's more valuable as a tool, Merlin, when you look at when a C-suite a CEO or somebody is putting money
yeah,
in their company, putting money to work and buying like a large amount of shares, not some kind of like, 10,000
right,
shares or
right, right. The
something
big
like
box.
that, but a large bet. I think that is more pertinent than selling. But again, if you're looking at that graph where it's all red bars above, and even if you look at the insider selling page, it's been that way too. So that would be a sign to me that, these people are taking profits. Now, think about supply and demand, right? Well, supply above the market, right? Well, that's
Yep.
exactly what we're seeing here, right? Isn't it?
Yep. And I'll add one piece there for everybody. I believe that as well. When you see insiders accumulating, should be viewed as a very positive sign. Until Aubrey McClendon of Chesapeake Energy was buying hundreds of millions of shares of Chesapeake, vaulted it to just historic highs, and then he got a margin call because it fell sharply one day, and it triggered one of the biggest sellouts I think I've ever seen. So just because they're buying it doesn't mean you got to run and do some due diligence on it first. But
Yes, of course.
what else? You got some classes coming up here. I know you do he's got a Friday show, goes on every Friday. He's also got some webinars. So where can I direct people to get more info from what you're doing?
Yeah, so under our learning page, there's webinars archived and upcoming. I just did a 2-part series on moving averages. I'm getting some good positive feedback on that. First one was more about understanding about moving averages, and the second one, which I did today, was more about some advanced trend identification and advanced Merlin moving average techniques. The next week we're doing supply and demand, or we're doing support and resistance in terms of swing highs and swing lows, and also looking at floor traders pivots. And then after that, we're doing the squeeze, the TTM squeeze, which is a combination of Keltner and Bollinger Bands. Is a great tool to finding markets that are kind of in that sideways consolidation, that are coiling and getting ready to break out either up to the outside or the downside. But the one that I'm really excited about, and this is going to be May 15th, is I bring you a friend of mine I've known for almost 25 years, and he's an energy procurement. He's a CEO of a large corporation, and he manages power plants through North America and South America. And we're going to do a webinar, and I don't know the exact title is, but it's basically investing in America's electrical grid infrastructure. And he's going to give us a lot of insider information in terms about where the growth is, where, do we want to buy utilities? Do we want to buy transmission stations? All these AI, we talked about AIs, all these AI centers are have to be hooked up, and that the demand for electricity is going to maybe quadruple by the year 2030 because of all of these data centers. So, do we buy those who are waging the war, bet on the war, or do we buy those companies that are supplying the bullets and guns? So I think it will be a very fascinating webinar. That's, again, May 15th. And I think a lot of alpha will be found in that hour program.
All right, great. Maybe we'll get you, because I'm going to forget by May 15th, but I'll definitely be checking your website. Maybe we'll get you back on to promote it the day before or something. But anyway, hey, I appreciate you coming on, sharing some insights with us. I hope all your trades have been green. I know you're on the bearish side of things right now, so I hope that prevails for you. And look forward to having you back on again soon.
Always a pleasure, Merlin, my friend, and you're always welcome back on my show. So until next time, sir.
Till I do. I will see you soon, John. Take care.
Bye.
All right, guys, that was John Rowland of barchart.com. Want more information? He's got a ton of resources. Again, especially for those of you who are starting out, these are some really good webinars. I've gone through and listened to a few of them. If you're looking at basic market tactics like moving averages, he's got some advanced strategies for moving averages. You can scroll through the webinar portion of their site. You go to Learn and then Archive Webinars, and there's all kinds of different topics here, which you'll learn a lot from those. So there you go. All right, Mr. Bearish apparently over here. I'm not always bearish. I've been like, stay long this market until it proves you wrong and then go short. Big Ab, you know what? You're going to buy me an extra large beer when you lose your bet on the 10-year bond. Okay, I'm going to have to go through this real quick. We won't even really look at the markets overall. Okay, fine, we will. Let's go check out our markets real quick. I have recording to do, and I can't do a 2-hour or 1-hour show. It was pretty ugly out there today across the board. Crude oil had a monstrous sell-off. I did not think we're going to bust this much to the downside on crude oil. I thought we kind of hold these levels right around 84.50. We knifed through those, down 3.13% for crude oil. Bitcoin continuing a pretty ugly sell-off, but notice we've had this kind of red line on the chart right around 61,000. We tiptoed down to 60 today, actually just below it. If you look at the futures, we got down to 59,705 before bouncing back up, and we're currently at 61,130. So let's see if this holds. I think it's pretty critical that it does hold this level. If it doesn't, then we'll probably see this thing drop all the way down towards that 52,000 mark, which obviously would be a long way from current levels. Now, NASDAQ, we looked at with John, looking weak. It did come into an area of demand as of today. Well, almost into an area of demand, which may hit tomorrow. Let me get these moving average lines off here. I was putting those on there for fun. I'll get rid of all that. Okay. So we do have that breakdown happening on the NASDAQ. You have it on the Russell as well. Russell, I mentioned for the past week, I think it's going to get to that 1939 level, 1940. We may hit that by Friday, the way it's been moving. Gold, still showing strength, even though the markets were kind of falling apart today. Gold was down just 0.81%. All in all, no trend change there. S&P breaking through and now looking for a floor. It broke down, made some new lows, retested. So this is exactly kind of what I was pointing out when I said, what are the steps for a downtrend to begin and become intact? You can make the argument that we are now beginning a downtrend on the S&P. Dollar index, big down day, but not. We'll see if the follow through happens. You're down to get a retracement from this big move that happened starting on April 10th. So not too concerned there. And then lastly, our 10-year, which actually was down on the day, showing kind of an engulfing pattern after it hit that targeted measured move. Okay. That's it. What else did I have? I think I had some earnings for tomorrow, so let me just show you that one real quick, and I'll show you some economic data, and then I'll wrap it up because I need to get back in the studio and record, which I'm going to do here in just a minute. So on the economic front, here's what you've got cooking for tomorrow. For Thursday, the 18th, I will be in Las Vegas, so there will be no show tomorrow. You can see several members of the FOMC will be speaking. You also have the Philly Fed Manufacturing Index and existing home sales for the U.S. markets. That comes off the heels of what we had today, which was TIC long-term purchases. I don't know why it's not refreshed. And you had crude oil inventories as well. Earnings front for tomorrow, we have some big names. Netflix will be reporting earnings. You got Blackstone Group and Intuitive Surgical. And other than that, it's pretty dang quiet. It's an easy 60-minute show day. No, we're done. It's 54 minutes, my friend. I'm going to wrap that up here because I have just so much to do. I've got to record some videos and then get ready for my trip. So I will see everybody here on Tuesday. I hope you have a fantastic remainder of your week. I'm bullish on Merlin going 1 hour. Thanks, Brian. You have to short those stats because I'm not going to make it today. But thank you guys for the support. If you guys want to get more information on John Rowland, you can go to barchart.com. He's always got great information, educational content there, as he's the head trading educator over at Barchart. So that's it for me. Again, have a fantastic weekend. I hope the last couple days of this week are great to you, as well as Monday, and I'll see you guys back on Tuesday afternoon. Feel free to email me any thoughts, comments, suggestions of topics you want to cover. That's at TraderMerlin@gmail.com or down below any of the YouTube videos. Take care, everybody. I will see you all on Tuesday.